As I speak to you right now, Circle Internet Group Inc. is trading at exactly 68.56 USD, pushing upward with a gain of 1.64 USD, or 2.44% for the day. That green number on your screen might look like a relief rally to the casual observer, especially if you have been watching the absolute carnage this stock has endured over the last month. But if you think this 2.44% bounce is a signal that the worst is over, you need to pause and look closer at the order book. What we are seeing today isn't just a simple recovery, it is a battleground between retail capitulation and institutional accumulation. The expectation from the retail crowd, those trading on Robinhood app or scrolling through SoFi investing forums, was that Circle, ticker symbol CRCL, would be the ultimate proxy for the crypto asset bull run. Investors expected a stock that moves in lockstep with Bitcoin, a high beta play that would skyrocket as digital assets gained adoption. That was the narrative sold during the IPO in June. The reality, however, has proven to be far more complex and frankly brutal for those who didn't do their homework. Circle isn't behaving like a tech darling. It is behaving like a sensitive interest rate instrument wrapped in blockchain technology. While the street expected a tech explosion, the reality is that Circle's revenue model is almost entirely dependent on the yield curve, and the market is finally waking up to the fact that 90% of their incoming cash flow comes not from transaction fees, but from the interest earned on the massive pile of treasuries backing their USDC stablecoin. When you analyze the price action over the last few weeks, the tension becomes palpable. We saw the stock plummet from a dizzying 52-week high of nearly $399 down to the 60s. That is a value destruction that would make even the most hardened Tesla stock or Nvidia stockholder flinch. But today's move to $68.56 tells a different story. We are seeing a stabilization in volume, which suggests the panic selling is drying up. The dumb capital has largely exited. Now we have to look at who is stepping in. While retail traders on interactive brokers trading platforms are cutting their losses, we are seeing filings that suggest heavy hitters like Millennium Management and D.E. Shaw are quietly building positions. This creates a classic divergence. The public sentiment is fear, but the smart capital is betting on a reversal. The market is currently pricing Circle as if interest rates are going to zero overnight, destroying their net interest margin. But that view is likely exaggerated. If you look at the broader financial picture, yields are stabilizing, and Circle's operational expenses, while higher than anticipated, are being deployed to build defensive moats that competitors simply cannot cross. Let's examine the intraday mechanics we are witnessing right now. The stock opened today with some hesitation, likely due to the lingering effects of the recent Mizuho downgrade, which cited those rising operating costs. However, as the session progressed, we saw a clear bid support level form around $67.50. This is technical confirmation that buyers are willing to defend this zone. It is fascinating to compare this to the activity we see in Schwab Intelligent Portfolios or Fidelity Wealth Management allocations, where defensive assets are currently in vogue. Circle is weirdly positioned as both a growth stock and a yield play, which confuses the algorithms. When you invest online or use investing sites that rely on automated rebalancing, Circle often gets miscategorized. Is it a bank? Is it a tech firm? This confusion is where your opportunity lies. The market's inability to properly value Circle's core business, issuing the dollar of the digital age, is what caused the sell-off to overshoot to the downside. The drop was exacerbated by insider selling reports, specifically directors unloading shares, which always looks bad in headlines. But if you scrutinize the actual filings, much of this was pre-planned tax liquidity, not a vote of no confidence in the business. We need to talk about the business model because this is where the expectation versus reality framework really shines. The general public views Circle as a crypto company. They think of it in the same bucket as Robinhood Crypto or Coinbase, but that is a surface-level take. Circle is effectively a full reserve bank that operates on the internet. When you deposit funds into a Fidelity brokerage account or a SoFi active investing account, that cash sits there. When you convert fiat to USDC, Circle takes that cash and parks it in short-term US Treasuries and cash equivalents. They keep the interest. With billions of USDC in circulation, that interest amounts to hundreds of millions in high-margin revenue. The expectation was that transaction volume would drive the stock. The reality is that assets under management drive the stock. This makes Circle more comparable to Fidelity mutual funds or Interactive Brokers account balances than to a software company. The recent earnings report showed revenue jumping 66% year over year to $740 million. That is massive growth, yet the stock tanked. Why? Because the market is forward-looking. Investors are terrified that as the Federal Reserve eventually cuts rates, Circle's free lunch of 5% yields will vanish. This fear is valid, but it ignores the volume offset. If rates drop, crypto activity historically rises. As crypto activity rises, the demand for USDC as a settlement layer increases, boosting the circulation supply. So while the yield per dollar might drop, the number of dollars earning that yield could explode. This brings us to the ecosystem Circle is building. They're not just sitting on T-bills, they are launching the ARC and CPN payment networks to compete directly with legacy systems. Think about the friction you experience when you try to move capital between a Fidelity mobile app and a Robinhood cash management account. It takes days. It costs fees. Circle's infrastructure aims to make that movement instant and near free. If they succeed, they don't just replace checking accounts, they replace the SWIFT network. This is the Tesla stock moment for banking. The infrastructure is being upgraded from the ground up. The skeptics say regulation will kill them. I would argue the opposite. Circle has spent years courting regulators, positioning themselves as the adult in the room, compared to offshore stablecoin issuers. This regulatory compliance is their product. It's why Fidelity ETFs and Fidelity IRAs are more likely to integrate USDC than any other stablecoin eventually. They are building the rails that Schwab Intelligent Portfolios and SoFi Robo-Advisor algorithms will use to settle trades 24/7. Now let's look at the risks, because we must be objective. The bear case isn't just about interest rates. It is about competition and commoditization. PayPal has its stablecoin. SoFi could launch one. Robinhood might partner with someone else. If stablecoins become a commodity, the margins race to zero. Currently, Circle enjoys a duopoly with Tether, but Tether dominates offshore while Circle dominates onshore regulated markets. If the U.S. government decides to launch a central bank digital currency, does Circle become obsolete? That is the existential threat. However, the speed at which the government moves is glacial compared to the private sector. By the time a Fed coin is a reality, Circle could be so deeply embedded in the Interactive Brokers platform and Fidelity trading platform backend that ripping it out would be impossible. The risk is there, but it is a distant one. The immediate risk is simply execution. Can they manage their ballooning operating expenses while navigating a lower rate environment? The recent 40% drop suggests the market thinks they will struggle. The 2.44% rise today suggests the market is starting to think the punishment was too severe. I want you to take a moment and think about your own portfolio. Comment below how many shares of Circle you currently hold, or if you are waiting for it to drop further before you enter. I'm genuinely curious to see where the sentiment is among serious investors versus the panic sellers. Comparing Circle to the giants of the industry helps frame the potential upside. Look at Interactive Brokers stock trading metrics or Charles Schwab's valuation. These companies trade at multiples based on their reliability and asset base. Circle is currently trading at a weird hybrid multiple, part tech growth, part yield bank value. If the market decides to value it purely as a tech growth story, like SoFi stocks or Robinhood investments, the multiple expansion could be significant from these levels. We are sitting at $68.56. Analysts at firms like Canord and Citi have price targets in the $240 range. That implies a potential 3x or 4x from here. Of course, analyst targets are often lagging indicators, but the spread between the current price and the street's consensus is historic. It suggests a massive dislocation. Either the analysts are completely wrong about the business model, or the market is pricing in a catastrophe that isn't visible in the balance sheet. Let's discuss the institutional flows